Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to the Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Joining me today is Jordan Sute Norton. She is with Sute CPA, and today we're going to talk about tax credits you should know about in 2023. Jordan, you've become a regular on the podcast. Thank you for joining us. A lot of our clients use your services for tax preparation each year. And evidently our podcast is becoming famous. We're getting, I think we're in the top 25% of all podcasts now. So, yeah,
awesome.
No, I'm going to start preparing for these things.
Right? Yeah. You can't just wing it anymore when
Just
you're
can't wing it.
25. For sure.
So, when we start off with talking about a tax deduction versus tax credit, this is something that I think a lot of people get confused about.
Right. I think people use them synonymously too. Like they say tax deduction when they mean credit, or they say credit when they mean tax deduction, when in reality, they both are good, but they do very different things. Tax deductions are reducing your income. It's not, I think people think, hey, they get their tax return and they say, wait a second, I forgot to give you my $3,000 gift to this charity, Habitat for Humanity, and they think their taxes are going to come down as a result by $3,000, and that's not the case. Instead, it's reducing your income that then the tax is levied on. Whereas if you have a tax credit, it's a direct dollar for dollar reduction of your tax liability. So your income's already set in stone. We levy the tax, and then we're able to knock it down with tax credits. So they're both very useful.
So a tax credit sounds better to me.
Yes, it is better. There's less tax credits than tax deductions, but that's because they are more valuable.
So an example of this would be like in Georgia, we get to deduct our up to $8,000 per student for 529 plans, right?
Yes.
So if you're putting in $8,000 for your child's education in Georgia, the tax is, we'll call it 6%.
Mm-hmm.
That's actually a $480 deduction in your tax.
Yes, exactly. Yes. You're knocking down your income by $8,000, but then we still have to levy the 6%. So effectively your savings is $480.
Right. So you're not putting in $8,000 in removing $8,000 in tax liability. That's the deduction versus credit.
Yep,
where with the $8,000 credit, you would get $8,000 off the bottom line, right?
Yes, absolutely. Yep. And I think there's a lot of confusion, especially with Georgia 529 plans. And then as we'll probably get into later, the goal, Georgia goal.
Yeah.
We've seen tax returns from non-Georgia preparers. We have new clients that come in and we're like, wait a second, last year kind of got wonky because these are two very different things affecting your taxes differently. And you got to make sure you get them right from the jump to be correct.
Okay. So when we talk about deduction updates.
Yeah. So for 2023, a few updates. I know that the cost of living has gone up for everybody. And so the government's helping us out just a little bit here in taxes. The mileage rate, that actually went up in 22, but it's still in effect at 62.5 cents a mile. So it's, pretty nice deduction there. And again, these are deductions, not credits. So These are helping reduce your income before the tax is levied. The retirement, there's every year, we see a slight increase in retirement. If you're participating in your company's 401k, you can suck away $22,500 this year, plus an extra $7,500 if you're over 50. So that's a nice deduction there that we always encourage. That's a low-hanging fruit, but max out your retirement where you can. Always good to defer. And then teachers, I know it's not even a dent in the bucket for you guys, but typically you can knock off $250 of unreimbursed expenses, but for 2023 it's up to $300. So
so generous.
I know, right? We'll take it when we can get it, but hopefully one day it'll be more than that. But at least we're getting a little bit of an increase this year.
Okay, so let's talk about refundable versus non-refundable tax credits.
Yes. So tax credits are great because they're reducing our tax liability, right? So Some are non-refundable and some are refundable. The best ones are refundable. So that means that, let's say your tax liability is $5,000 and you have $6,000 in refundable tax credits. Not only is it going to reduce your tax to zero, whatever's left over is then yours to take home. So that's awesome. You're taking money that's, technically wasn't even yours to begin with. So refundable tax credit, whereas most of the credits we see, they're non-refundable. So they can reduce you to zero. But after that, there's not much more you can do. Oftentimes they can carry forward. So you can use them in future years when you have tax liability, but you're not gonna be able to take home any money that wasn't yours.
I mean, for refundable tax credit, that's got to be probably really centered toward low income.
Right, earned income credit, we see it a lot there to become refundable, but yeah, it's not something super common.
Okay, so let's talk about credits that are sitting out there right now.
Yes.
Electrical vehicle credits. Does that still exist?
Yes, and it came back this year, although it's totally different than we had seen it previously. When you think about electric vehicles, Teslas, I know there's a lot of Volvos, and I feel like every car manufacturer is making these electric.
Something now.
Yeah, they're just becoming super popular, and they're eligible. Most of them are eligible for this really great tax credit. So with the new EV credit, we're looking at certain dates here of when cars are placed in service, but the big one for this year was after April 18th, 2023. There's a new EV credit. And so the max is 7,500, but there's a few kind of requirements there, battery or like mineral percentage, very kind of nuanced. But if you're at an EV retailer, a car dealership, they have very strict requirements, and they're going to be the ones to tell you this car qualifies, this one doesn't. And you also need them to say that, because if they sell you the car and you want to go after this credit, they've got to also furnish the information to the IRS themselves.
Oh, wow.
Yeah.
Okay.
So you're self-reporting, but also at the same time, they're reporting for you as well. So the information will need to match. The only kind of downside here is that the income limitations are much lower than they had been previously. So for a single taxpayer, your AGI can't exceed 150, and for married taxpayers, it can't exceed 300. The good thing, though, is that if you buy a car this year, say you're married and you're going to be making 350, so yeah, let me go get a Tesla. I'm making some good money. You wouldn't be eligible for the credit. However, if you were under 300 last year, you could use last year's AGI to qualify for a car purchase this year.
Okay.
That's a nice kind of little a way to scoot in when you might not otherwise be able to.
Interesting.
Yeah.
So basically, anyone making over 300,000 is deemed no credit.
Yeah.
Unless
they could qualify under the previous
under the prior years. Interesting.
Yep.
So that's a bottom line number, though, right? It's if you do qualify for the 7,500, that comes off the
yes,
the bottom line.
Yep, non-refundable, but it's off your tax liability. I actually was looking at Teslas this morning. I don't think I'm actually going to do it, but I was just curious looking at their website, and they even, on all of the models on the Tesla website, they report the vehicle cost is after the tax credit. Yes. They're like, yeah, it might cost 50, but it's actually 43,
Yes, exactly. Yeah. I remember when they first rolled out all those credits and going, oh, this is not expensive as I thought. And I was applying the credit to the already applied credit price. And I'm like, oh yeah, never mind.
Yeah. Gotta watch out for that, for sure.
So let's talk about home improvement credits.
Yeah. So lots of really good things going on here. I want to start with the solar panels, because I think that's the biggest opportunity. And even as you drive around, I feel like Cobb County, I start to see more and more homes that have solar panels on them. There's huge tax savings there, even if you choose to finance those solar panels. So I know that's a big option for a lot of people. Get rid of your power bill and instead take on payment for your solar panel. But hey, in 10, 15, 20 years, they'll be paid off, and you won't have electric bill or solar panel.
The problem is that solar panels aren't good forever. So in 10 to 15 years, you could be needing new solar panels.
Fair enough. Very fair. Yes. However, there is a great tax credit. So up to, there's no limit here except for your tax liability. So if you go and you put in, let's call it $50,000 worth of solar panels, the tax credit is 30% of your cost. So 50,000, that's what, $15,000 tax credit. So, and it's not refundable, but carry forward. So it'll reduce your tax liability to zero, and then you can carry it forward. But I feel like that's just such an awesome credit, because there's no limit there. Whereas in the other home improvement costs that we'll get into, there is like a
Right.
very strict, very low lifetime credit that is kind of limiting. But the solar panels, and it's also like solar water heaters as well. There's
Yeah.
lots of upside to the credit.
So basically, $50,000 in solar panels would equal a $15,000 credit.
Mm-hmm. Yeah. So, and I know a lot of places or a lot of taxpayers in Florida. That's a big place, where I see
Yeah.
a lot of solar panels. It's an awesome credit for sure. And then on
Yeah.
the
You just have to do an Excel spreadsheet outside of the salesperson to
right.
make sure that it all comes in line. I mean, I look at my power spend right now, and it's pretty low. What's high is, waste and waste and water are relative to the power, but we don't consume as much power as we think we do, maybe.
Right.
But if I'm spending $300 a month, let's say on a power bill, actually it's not even that high. It's $250 a month. I just wonder what the break even is. That's something that we'll have to dive into on that. But $15,000 off, a $50,000 improvement, that really helps you get over the hurdle.
Right.
And then also too, I mean, maybe you can ask this question. I mean, in some cases, I don't know if this is true in Cobb County. I know it happens in other municipalities. You can sell the power back to the power
Oh
company.
yeah. I've heard of that
So
as well.
is that counted as income?
I would have to assume so. I mean, if you have
Yeah,
that,
you have to
they're going to say yeah.
They're going to send you a 1099.
Yep. Yeah.
But even if they did, that's not that big of a deal. I mean, it's still more. Even if it was taxed at 20%, that's still 80 cents more in your pocket per dollar than you had before.
Right. Absolutely.
If you can sell it back to the municipality, that obviously helps with the cost in addition to the credit. So there could be something there.
Yeah, absolutely. And then kind of on the lower end of things, if you replace your windows, or I know that there's other home energy efficient things that you can improve on your primary residence. And again, this has to be primary residence. You can't put solar panels on your rental property and then
Right.
receive this really nice tax credit, or home
Got it.
energy improving windows or whatnot. There's also another tax credit, but it's lifetime. So starting in 2023, the lifetime credit is $1,200. So if you go out and you put 10 grand of new windows in, there's a tax credit up to $1,200 that you can use to take off your taxes, but then you won't get that again in the future if you put $10,000 of new windows into your next, primary residence. So again, it's there. And if it's available to you, I suggest to take it. Just know that it's not going to make or break any year for most people.
Okay. What do you think has to be done? I mean, you just can't do it and say I did it and you check a box on the tax return. So what's the procedure for?
Right. So what we look for as CPAs when we're preparing taxes, there's often the invoice, whoever's preparing the company that's installing or that you're working with, they have very strict measures of giving you the proper documentation. And I would suggest ensuring, hey, you say this is going to give me a tax credit, show me the background, or give me something that I can give to somebody and would stand up if it was ever questioned. So definitely I would use reputable installers and companies to help you with these products, because anybody could say, I could go tell you, hey, Casey, I'm going to come to your house and put in new windows and you're going to get a $1,200 tax credit, but I wouldn't have anything to give you to back that up. So I would recommend, proper documentation from qualified installers and retailers.
Okay. What are some recurring credits that may have changed in 23?
Yeah, so not a ton of changes here. A few years ago, we had some kind of exciting things happening with the child tax credit, dependent care credit, kind of centered around COVID, but everything's kind of just gone back to normal. But still, there are things that make sure that you're taking advantage of, especially if your child is in daycare. That's a cost that we can get back on the return. I just have to reiterate, I feel like we see a lot of this Mother's Day out. If one of the parents doesn't qualify. We have to have 2 working parents here to qualify for this credit. But first, if you can, use that dependent FSA at your employer. But again, the only way we can use that is if both spouses work. So max out your FSA, your spending account, and then whatever's after that, or if you don't have one of those, whatever you're spending on daycare, we can get some costs back. It's not as awesome as you might think, but anything will help in the long run.
What
And
about,
then,
yeah, so say education credits.
yeah, so these, the American Opportunity Credit and Lifetime Learning Credit, nothing new here. And the downside, a lot of our clients can't qualify for this because the income limitations are pretty low. Where I think you really see the benefit of these are young adults who are putting themselves through grad school or paying for their own college, or they're working enough during college. Maybe they're still getting some money from mom and dad, but if they're working enough in college and maybe mom and dad are phased out of tuition credits,
Right.
but they have a job where they're making, 25, 30 grand a year, but they're also in school, they have the opportunity to take advantage of these credits and see some real impact. So I think that's, you definitely don't want to be skirting any IRS rules by, hey, mom and dad's still sending me, more than half of my support. But if we can make an argument that an adult child is providing more than half of their support, that's a great opportunity for them to take advantage of an education credit.
So let's look at a scenario where I think this is a common question. Household income is north of 250,000 a year, and they're putting their kid through college. Let's say they go to Auburn, but they're paying full freight. So they're spending $60,000 a year in tuition. There's no tax deduction for that. Is that right?
That's right. Yeah. And you're still going to get a 1098T, but we'll input it every time that we see it. But oftentimes you're just income limited because it's really meant for lower income or medium, income taxpayers to take advantage of. And I know it's a huge expense, but it's just we're kind of stuck with the income limitations there. That's where, to the opportunity, we can have a child that's working in college help maybe come off of our tax return as a dependent. I think that's where the biggest opportunity lies for taxpayers like the ones you mentioned.
Okay.
And I think that kind of segues into too the retirement savers credit.
Mhm.
That's a credit for people, and again, this is super income limited, very low income limits here. But if you're working and you're putting money into a retirement account, the IRS loves to see that. They want to see lower income taxpayers doing that. And I feel like where we see it most often are on tax returns of kids who are coming off as dependents and they're starting to work in those first few years.
Yeah.
That's where we really can make the benefit. Put money into retirement because the IRS is gonna pay you back for it. They want you to. They're encouraging the.
Can you explain that a little more? Let's say my child just graduated college, they got their first job, they're making 35,000, 50,000.
Yes, they're a great. That's a great example. If they're putting money into their company's retirement plan, and we'd see that on their W-2,
Yeah.
code B or whatever it may be, code S if it's a simple. If they're putting money into a retirement plan through their employer, or if they're self-employed and putting money away into a retirement plan, there's a form, the retirement savers credit, where if they're within the income limitations, the IRS will give them a credit back for a portion of the money they're putting into their retirement plan.
Okay.
Again, not a make or break, but if you can take advantage of it, why not?
Sure.
Yeah.
What's changed with the adoption credit?
No changes here. It's just something that I think gets forgotten about. It might not be something that you bring up to your CPA every year, but and again, it's income limited, just like most of these credits, but it's something that every time you have a significant family change, whether it's having a new baby or, as we can talk about for Georgia, even being, having a child in utero, being pregnant, these are things to tell your preparer, or if you're going through the adoption process. I know that is so expensive, and the IRS understands that, and so there are available channels for you to receive a credit there. You just have to at least say, hey, what about this? And
Yeah.
as a CPA, we're not as involved as maybe a financial advisor is to hear about every single life change in your life, but it's worth bringing up. And I will say there was a client of ours this past year who made a note in their tax organizer, gave birth to baby like January 3rd, 2023. And so at first I'm like, oh, that's wonderful, but no, that won't help us for 22. But in fact, was a 22 tax credit put in place, well, not credit, but deduction put into place for Georgia, where if you were even pregnant with a child throughout 2022, that qualified as a dependent on your Georgia tax return. So they're giving credit for unborn children as well. So by just notating that on their return, hey, here's an extra $200 that'll go into your pocket from Georgia because of that notation.
Interesting.
Yeah.
So I had a question recently about a minor Roth account. And normally when you put money into a Roth, you have earned income.
Mm-hmm.
So we see this with small business owners. They hire their
Mm-hmm.
child, they pay them $6,000,
Mm-hmm.
and they put the $6,000 into a Roth,
Mm-hmm.
right?
Yep.
Um, and so that's something to think about because that's a great way to transfer wealth
Yep.
and get them a huge head start for retirement. But if you
Right.
don't own a business, and I know I'm putting you on the spot here because we didn't talk about this beforehand, but I saw this for the first time. They said, well, we paid our child an allowance. And so that they did chores around the house and it was like $600. So it's below the threshold, right, of
Mm-hmm.
reportable income.
Mm-hmm.
And then they opened up a Roth IRA and put the $600 into the Roth IRA, stating that, well, they earned it because they did chores around the house. I thought that was a bit of a stretch.
Yeah. I like it. That's genius. But yeah, I don't know what the IRS would say, but
yeah, I thought
that, I mean,
I
yeah,
was like, I think that's definitely a gray area. And I think, I mean, $600 isn't that big a deal, but when they're like 2 years old, like what chores were they really doing around the house, right? And
right.
um, but certainly when they if they get jobs as teenagers, that's something that you could look at as doing a minor Roth, and that
Yeah.
really compound over 40 something years,
Right.
be a good investment.
Right. And even to the extent that we had a client a couple years ago, I was so impressed by what this client and his daughter had done. She got an internship in the summer. She was in college, got an internship. She made like right at maybe 12 grand. And her net paycheck was like $5 because she had put all of it into her employer's Roth 401k. They let her participate even as an
Oh
intern.
wow,
And then we go to file her tax return, and sure enough, we report the 12,000 of wages because we
yeah,
had to, but there was no tax levied on that amount because it was underneath the standard deduction. So she put,
mm,
12, essentially all of her summer earnings into a Roth account without paying tax on it once, but it was
yeah,
totally legal because she was beneath the limit of the standard deduction. But I'm sure, she had expenses still. That
right,
takes a parent who's willing to still, give your child an allowance. But I thought that was just genius,
yeah, that's
to
awesome.
set your child up for success.
So let's transition to Georgia specific credits. What do you have in mind?
Georgia, if you go to the Georgia Department of Revenue website and you just Google, credits, you're going to see there are so many different Georgia credits, and quite a few of them are transferable. So that means another entity generates those credits and they generate a little too much, and then they're able to either transfer them to you or sell them to you at maybe a discounted cost. That's saving you some money, but there's significant opportunities in Georgia for ways to reduce your taxable income.
There's in some circles, I feel like film credits have gotten mixed in with the land credits. Land credits bad, film credits good.
Yes, film credits are good, especially the audited ones. I mean, we haven't had any trouble with non-audited credits, but to the extent somebody offers audited film tax credits at a reasonable price, we think that's a
Yeah,
no-brainer for tax savings.
and that's
And
saving, and that's saving on Georgia tax.
yes, exactly. So with COVID, this used to be huge before COVID. They were essentially 90 cents a piece or 89 cents a piece. So you would pay somebody 89 cents for $1 of credit. So you're
Mhm.
saving 11% there, and you could buy up to whatever amount you needed for your
Yeah,
Georgia returns, and you could even retroactively amend tax years that had already ended.
uh,
Um, to get a refund. So that was just an awesome way to take advantage. As COVID happened and movies became less and TV shows were filmed less, the credits kind of depleted there for a while, but we're starting to see them come back. And they're right around the limit where I'm sure a financial advisor would say, okay, I think maybe yes, we can start playing with this again. But the prices are starting to look a lot better than they had for a few years.
that's good. Well,
Yeah.
because there's more film being produced. I see that here near our office all the time. There's a church parking lot next door, and all
Yeah.
last week there were uh, all the movie sets come in. It's amazing how fast they set that stuff up and break it down and move on to the
Yeah.
next set.
And it's fun as for us because we'll see the credit reports or the documentation. It'll be like Stranger Things season 4. So you're buying credits
Find
for
the
real
shows that
movies,
you
and
watch. That's
yeah,
awesome.
it's really cool.
What about low income housing credits?
Yeah, I think we see this less in the film tax credits just because they're a little bit more, there's some kind of more rules associated here. You can't go retroactively. So you've got to buy the low income housing credits in the year that you're wanting to use them. So that takes a little bit more work of, hey, what's my liability going to be? But to the extent you overbuy, you can carry forward. So it's still a good, we think a good investment. And you're buying as a part of a syndicate as opposed to where the film tax credits, you're buying for a particular film. So it's still a good opportunity, a way to reduce tax. They're sold at a discount. So that's where your savings is coming into play. You're buying enough credits to cover your Georgia tax. You're just buying them at a lower cost.
Okay. And so this would apply to anyone who has state tax liability, which, in Georgia, we don't have an exceptionally high tax rate, but if you're a high wage earner, that number increases pretty quick.
Right. And the good thing here too is that with Georgia, I know that there's the new pass-through entity tax election that you can make. So, and we can get into this, I'm sure, on we could use a whole episode to talk about PTE and the benefits. But now these pass-through entities, your partnerships and your S corps can pay tax at the entity level, and there's significant tax savings. And so those entities can also be purchasing the credits as well. And so there's kind of a double tax savings play there.
By your S corp purchasing the tax credit, and then that cap passes down to the personal tax return, but off as an expense as well.
Well, yeah. So if the S corp's paying the tax, you're getting the deduction for your federal purposes. So that's where the saving is coming into play. But the entity is not passing through any Georgia income. Besides that, maybe if you're an S corp owner, your W-2 is still on your personal return.
Yeah.
But then whatever tax.
So your earnings, your distribution, or at the end of the year, your profit, basically.
Yes, your profit's staying at the entity just for Georgia, not for, your federal still flows through.
Yeah.
But you're receiving a significant tax savings on the federal side. So now your entity has the tax due. And instead of, just writing a check or, you have to go online and pay it, you can buy some credits at the entity level to fulfill that obligation.
So what's the deadline for setting something like that up?
The PTE? Or for PTE, there's no debt. You make the election with your tax return. However,
you can do it after the tax year is over, retroactive.
Yes, because you're just electing with the return. Because in a year that you have a loss, you don't elect PTE. You want that loss to flow through. So it's a year by year basis. And then the only thing is if your cash basis, we'll want to kind of be strategic about when you make your tax payment, because if you wait to make it with your tax return, then it's a tax savings that year. So let's see, we're in 23 now, the best case scenario is to make your tax payments by 12/31/23 for Georgia for it to count for 2023. If you wait until April, then it's a 2024 deduction. So it's just a timing game, but it's worth it nonetheless.
Okay. Would that apply to the film tax credits as well?
Yes. Yeah. So let's say that you decide in March or April of 24 that you are going to elect PTE and you're going to pay tax at the entity level for your S corp or your partnership. You do that with your tax return, and then you can at the same time go buy tax credits, and to fulfill that obligation at the exact same time, and it'll go retroactively to the past tax year.
So let's shift gears a bit. Let's talk a little bit about like higher wage earners that are, W-2 employees. It's really hard for someone who's making $500,000 a year or more. It's really hard to find deductions.
Absolutely.
Pre-tax, you hopefully you're at a larger company that has like deferred comp plans or something like that.
Yep.
But those film credits could apply to someone.
Yes.
In that situation to save money on Georgia return.
Yes. That's where it kind of stinks, because you're likely having Georgia tax withheld from your paycheck, and then you're also going to have to write a check to the film tax, whoever's selling the film tax credit. So you're out twice, but you're going to get the money back. So or
10% of it back.
10%, yes. You're going to be making 10%. I feel like at times.
Well, actually, you get everything you paid into your paycheck back plus 10%.
Yes, exactly. Right. So, but coming out of pocket twice without being refunded, it's kind of a hit. But we think once you hit 90 cents on the dollar for some of these film tax credits, we think it's worth it.
Okay. Well, Jordan, thank you for your time today and the 2023 insights. I know we'll have other podcasts in the remainder of the year, especially as we get more toward tax planning, which is usually done in September, at least here at our firm. But yeah, thank you for you and Michael and all you do for Wiser clients.
Absolutely. Thanks.
I'll talk to you next time.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investment advisor with the SEC. The host and/or guest may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guest of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.